Welcome back to Dion Talk. It's official. I am joining the Crash Bros. And I want you to understand how important that is because of how much I hate the Crash Bros. But the actual real estate crash in 2025 that will bleed into 2026 that I actually see coming, which I'm going to back up with some data that I probably should do on the whiteboard. So in my next video, I will probably be whiteboarding some of this out. But this real estate crash is coming because some people are following some really bad, they've been following this for 10, 20 years, really bad Robert Kiyosaki advice. And I'm a Robert Kiyosaki fan, right? He was a Marine, I'm a Marine, he invests in real estate, I invest in real estate. He's gone a little bit crazy in the last couple of decades, but there's advice that he's been giving since day one of his formula, and I am a fan of the Cash Flow Quadrant too. So you should check out Rich Dad Poor Dad and Cash Flow Quadrant, two of his good books. But don't follow this advice that's been setting up people for absolute failure in real estate that's going to be the cause of this next really bad crash, way worse than 2008 in my opinion. And no, this is not clickbait. I'm not making this up. I'm actually going to prove how I believe there's a real estate crash coming in 2025 and in 2026. And it's going to be bad. And it's going to create a sweet spot. At the end of the video, and this is going to be a short live, I'm going to tell you the sweet spot where you can actually put your money to work and benefit from this crash. So in 2007, just before the 2008 housing crash, there was some writing on the wall that a few people called. Most didn't, because that's why the crash happened. And some of that data was 51% of mortgages had an adjustable rate. And when a rate adjusts, right, interest rates can go up. People's incomes don't always go up. Rents don't always go up. So when the loans matured and those rates adjusted, tagged in with the recession, tagged in with ninja loans and toxic debt being, so there's a bunch of contributing factors that made a really bad crash. We are in the middle of the perfect storm to cause a massive crash in debt. The problem is going to be debt in 2025, 2026. In commercial lending right now in the United States, and you can Google this because I did too, and I would be using fancy charts if I was one of those guys who edited my stuff, 85%, that's a lot more than 51%. 85% of commercial loans have an adjustable rate, right? And this is crazy. This is where the perfect storm comes in. In 2020 and 2021, 2022, interest rates dropped, right? We had a pandemic, an eviction moratorium. We were trying to spur the economy. Interest rates went really low. In 2020, I became what's called an accredited investor, right? Net worth passed $1 million, finally had the ability to get on some lists where people were pitching me some really bad deals. Like, and I mean, some of the biggest names in real estate podcasts were attached to these deals. And it was, projecting interest rates to stay flat or to go down and rents to keep going up. And these were 526 unit apartment complexes in Texas. And Thatch Newen talks about the bigger the name attached to the deal, the worse the deal could be. And that's kind of holding true for me. The ones I looked at and I didn't invest in, but a lot of people did. And there were, because of debt resetting, when the loan matures, I will explain how a building that sold for $129 million was resold for $48 million. So not only did the investors lose their money, but the lender took a massive cut. And the people who put the deal together usually make their money during the deal, not during the exit strategy. So somebody made money. So the problem is the way the lenders look at the valuation of the property. So if you're investing in, and just to name a few, storage, mobile home parks, commercial, office space, warehouse, multifamily, like 20, 30, maybe 100 unit apartment complexes. People acquired these deals in 2020, 2021, 2022, or refinanced in 2020, 2021, 2022 to somewhere between a 3 to a 5% interest rate, right? Owner-occupied stuff can get all the way down into the 3s. Buying down the rate can get you down to 3s, but a lot of these loans were in the 4 to 5 range. Interest rates today in 2025, we're in the 7 to 10 range, depending on the type of loan, right? DSCR, commercial. And here's the way that lenders look at it that causes the problem. Lenders use a ratio. They don't use net operating income, right? That's how we find the value of the property. They don't look at comparables. They actually use what's called a 1 to 1.1 point, 1 to 1.1 ratio. And I'll use really simple round numbers, and you're going to have to multiply these by millions to get to where commercial real estate really is. But let's say you buy a property, and why did my lights turn off? So you buy a property, and the mortgage expense every month is $1,000. Right? So we'll call that the one. $1,000 is the one. The lender wants your income to be 1.1 that ratio. So that would be $1,100. If your mortgage going out is $1,000, that property needs to take in $1,100. Now, this doesn't really impact it much if your property insurance goes up, if your taxes go up, if rents don't trend up as much as they were saying they were going to. What's really happening is you buy a property in 2020 or 2021, or you refinance it in 2021. Now your loan's maturing, your 3 to 5 year loan. You're going to have a loan reevaluation period, and they're going to look at the income versus your payment. Now the payment when you had that 4% interest rate was $1,000. Well, now your interest rate is somewhere between 7 and 10%, and now your payment's going to be around $1,400. So, and again, multiply these by millions to get what was actually going on with commercial real estate. Your rent didn't go from $1,100 a month to the $1,400 a month, because that would be a 1-to-1 ratio. Your rent actually had to go, in order to keep this property, your rent would have to go from $1,100 a month to over $1,500 a month, right? Over 15, whatever the math is, of 1,400 times 1.1. Rent didn't. So now the storage facility, the mobile home park, the asset doesn't make enough money to meet the 1.1 ratio that the lender wants. Your rate has adjusted, so you can't go refinance because all rates are that high. Selling would be a challenge because the people who are going to buy it are going to be buying it at today's interest rates, and not everybody has all of the money to put into the deal cash. So the lenders give you a couple of options. One, you can write a multi-$100,000 or maybe millions of dollars check to the lender to bring down the amount owed so that your payment is no longer $1,400 a month. You bring it back down to that $1,000 a month or $1,100 a month that you need. Well, do you have that money sitting there? Is that syndication flush with so many millions of dollars they can buy down the thing? So then they probably have to sell. But since they can't sell at the rate because the people can't buy it with the new interest rates, they have to lower the price so much that all of the investors' money's gone. The banks are probably going to take a loss. So yes, you can buy properties cheaper, but here's where the really bad Robert Kiyosaki advice comes in and why so many people are set up for failure with this. He has been saying this like a mantra since the 80s. It's, man, it's about the real estate crash that's going to happen in 2025, 2026, not clickbait. I'm actually covering the data. You might want to watch from the beginning later. And you came in at the 8-minute mark. Robert Kiyosaki has said, like a mantra, over and over and over, 3 greenhouses, 1 red hotel. 3 greenhouses, 1 red hotel. You've got to be somebody who's heard it, if I've heard it as many times as I have. So what happens? What does this mean? People like me, we invest in duplexes, house with ADU, triplex, fourplex. We gain some equity, we have some principal pay down, we have a levered appreciation position, so we get a lot of equity. And you hear people like the lumberjack landlord talk about dead equity, right? I have a really good cash-on-cash return. I have a really bad cash on equity return. So what millions of people do is they take their 3 greenhouses, which is your duplex, your triplex, your house with ADU, you sell it, you 1031, right? You benefit from the actual tax system to delay the taxes, possibly forever, with a stepped up basis. Even your heirs might not have to pay it. And you go and you buy that 15-unit apartment complex, or you buy into a syndication, you put your money to work. It's a little less hands-on. You don't have so many tenants at different properties that you're managing. It probably has a management company in place. Maybe if you're joining a syndication, you're just giving your money to the operators who are going to run it, right? This totally makes sense. You're now getting a better cash on equity return. But you bought in 2020, 21, 22, you had the 3 to 5% interest rate. Rents haven't gone up 100 or 200%. They've gone up 20 to 40%. And now you're hitting a loan reevaluation period as your loans hit a maturation state where they're going to look at your income versus mortgage, and you're not going to have that 1 to 1.1 ratio. These syndications, these apartment complexes are going to start falling apart because people followed his advice. And again, I'm a Kiyosaki fan, but they followed the advice of 3 greenhouses, 1 red hotel. They 1031'd into bigger deals. They followed the stack method. Well, now that's imploding. This crash is going to hit storage, office space, warehouse, multifamily, all of these things that have commercial debt. Because, and I said this at the beginning of the video, in 2007, 51% of residential mortgages were adjustable rate. We are currently sitting at 85% adjustable rate in a time period where in the last 3 years, rates have doubled to tripled, right? 3% became 9%, 5% became 10%. We've seen interest rates double and triple as the loans are maturing. So this next year, here's where the sweet spot's going to come in, where the opportunity is. First, I can't believe I made a video where I'm joining the Crash Bros because they have cost people hundreds of thousands of dollars. But I'm actually doing this because I believe that this is where the crash is. Here's the sweet spot. For those people who have the down payment or they have built the 3 greenhouses for the 1 red hotel, you've got the duplexes, you've got the house hack, you've got a rental, you've got your house, whatever it is, and you want a 1031. Apartment complexes, 10 units or less, that right now have adjustable rate, have had their interest rates double or triple. And not all of them are going to know about this opportunity to go and refinance with someone like Convoy Home Loans or Velocity Mortgage. Up to 10 units, they offer 30-year fixed rate debt. So the person in the position right now owning the property has probably made this huge mistake in 2020, 2021. And I'm gonna multiply this by millions. If their mortgage payment was $1,000 and their income was $1,100 and interest rates dropped, they not only refinanced, but they pulled out equity, right? That's what everybody talks about. They added debt to that existing asset to buy more things. So they're at that 1 to 1.1 ratio. They can't refinance into these new high interest rates. So when the haircut happens, when they lose their money, when the lender takes a haircut and that property, 10 units or less, goes for sale in the next year or two, and you know about the opportunity of reaching out to Convoy Home Loans, Velocity Mortgage, or one of the people who offer 30-year fixed rate debt on 10 units or less, can acquire that asset with your 1031 that gives you a big enough down payment to where you can cover the 1 to 1.1 ratio that the lender is going to require. You have fixed rate debt, so if interest rates go to 14% in the next 10 years, you don't lose the property. If interest rates go to 2% in the next 10 years, you refinance and increase your income. So I made a video where I joined the Crash Bros. I talked about the crash that's coming. I didn't talk about why you should invest the way I do. I just said, here's the people that made the mistake in the last 3 to 5 years. Here's how you can benefit from it. And I used actual data that you can verify by looking up what percent of commercial loans have an adjustable rate right now in the United States. What has happened to interest rates since 2022 to today? I hate making fear, doom and gloom videos, but I gave you a ray of hope at the end. There was a sweet spot where you could put your money to work. I'm going to make this video a couple of times. I'm probably going to whiteboard some of this information, but I want people to understand that, yes, if you make a crash video every 2 months and you've been wrong for 5 years or 10 years, you should probably stop making them. So if I make commercial real estate crash videos for the next year and it doesn't happen by the beginning of 2026, I'll stop making them. I'll leave them up so people could see how wrong I was, but I'm calling out actual data of real things that are happening today. You can look up how many commercial properties sold for over 100 million 3 years ago that are now selling for less than 80 million today. And who's losing that money? If you want your questions answered during a live stream every Tuesday at 4 p.m. Pacific, I do live streams that last as long as the questions do. Have a day full of awesome.